What if being wrong about money was actually impossible? Picture a world where unlikely profits routinely break the laws of financial probability. The market doesn't reward experts with fancy degrees or insider access. It favors the bizarre outsiders whose predictions seemed laughably absurd, until they weren't. Like the psychic who warned clients about 1929's crash 4 years early, or a cartoon that predicted Trump's presidency. In this video, we'll reveal history's most improbable financial forecasts that defied all logic, yet somehow materialized into reality, revealing the thin line between genius and madness. Because sometimes, the future belongs to those crazy enough to see it coming. 1. The Black Wednesday of 1992 reads like a financial thriller. George Soros, looking at the struggling British pound, saw what others missed: fundamental weakness in the European exchange rate mechanism. While UK officials desperately insisted everything was fine, Soros bet against an entire country's currency, shorting 6.5 billion of sterling. The Bank of England fought back, raising interest rates twice in a single day, burning through foreign reserves like a teenager with their first credit card. By evening, the UK announced its withdrawal from the ERM, and Soros pocketed over $1 billion. Fallout reshaped European monetary policy forever. Turns out you can fight City Hall. You just need a few $1 billion and nerves of steel. 2. In 2006, most economists were still doing keg stands at the housing market party. Then, Nouriel Roubini, an NYU professor with a doom-laden accent to match his predictions, stood before the International Monetary Fund and effectively announced the apocalypse. He warned of a massive housing bubble, credit crisis, bank failures, and global recession. The financial elite literally laughed at him. They called him Dr. Doom and dismissed his warnings as the ravings of a perpetual pessimist. 2 years later, when the exact scenario he described unfolded with terrifying precision, those same experts suddenly developed amnesia about their mockery. Roubini's vindication reminds us that in economics, being early looks exactly the same as being wrong, until it doesn't. 3. The year was 2006. Housing prices soared, mortgage lenders threw money at anyone with a pulse, and Americans treated their homes like ATMs. Enter Peter Schiff, appearing on Fox News with a warning. The United States is like the Titanic, and I am here with the lifeboat trying to get people to leave the ship. The financial experts opposite him practically choked on their coffee. They mocked him relentlessly, with one host asking if he was un-American for his pessimism. Fast forward to 2008, and the housing market collapsed exactly as Schiff predicted. His reward? Being right when everyone wanted him to be wrong. The case became a YouTube phenomenon years later, a time capsule of hubris before the fall. 4. It was March 9, 2009. The S&P 500 had plummeted to 676, down 57% from its 2007 peak. Fear was the only thing being traded on Wall Street. Then, amid the chaos, CNBC anchor Mark Haynes calmly declared live on air that we were witnessing a generational bottom in the market. No complex models, no team of analysts, just a veteran financial journalist with a hunch. The financial community shrugged it off as wishful thinking. What happened next? The market turned precisely at Haynes's call, beginning what would become the longest bull market in American history. Haynes never lived to see his full vindication. He passed away in 2011, but his eerily precise prediction has since been immortalized as the Haynes bottom, proof that sometimes a good pair of eyes beats a dozen algorithms. 5. While dot-com millionaires were busy ordering gold-plated everything in 1999, economist Robert Shiller was meticulously documenting the insanity. His weapon of choice? The humble price-to-earnings ratio. Shiller demonstrated that tech stocks had reached valuations so detached from reality that a massive correction was inevitable. In his landmark book, Irrational Exuberance, perfectly timed for release in March 2000, the exact month the Nasdaq peaked, he laid out the case for impending doom. Silicon Valley luminaries dismissed him as an out-of-touch academic who just didn't get it. 3 years and 5 trillion in evaporated wealth later, Shiller's warning stands as one of the most precise bubble predictions ever made. The lesson? When someone tells you, this time it's different, check your wallet. 6. In 2004, while Alan Greenspan was busy assuring Americans that housing prices couldn't possibly fall nationwide, economist David Baker was penning what would become economic prophecy. His article in The Nation didn't mince words. The crash of the housing market will not be pretty. It is virtually certain to lead to a second dip to the recession. The piece was dismissed as liberal fear-mongering at the time. After all, how could housing, the safest investment Americans knew, simply collapse? 4 years later, as millions faced foreclosure and the global financial system teetered on the edge of oblivion, Baker's warning seemed less like speculation and more like time travel. His reward for this foresight? Being largely forgotten in the parade of "I told you so" economists who emerged after the fact. 7. Long before Jim Cramer was shouting investment advice on television, America had Edgar Cayce, the sleeping prophet. In 1925, while in his trademark trance state, Cayce began warning clients about an impending financial catastrophe. "There is coming a condition of financial stress within this land, such as has not been seen," he intoned. 4 years later, Black Tuesday hit, and the Great Depression began. Cayce's predictions included details about bank failures and market collapse that would unfold with eerie precision. The financial establishment never took him seriously. He was, after all, a man who gave medical diagnoses while unconscious. Yet his forecast proved more accurate than those from the era's most decorated economists. Sometimes, it seems, the most unlikely prophets cast the longest shadows. 8. Economist John P. Hussman isn't flashy. He doesn't have a catchy nickname or television appearances. What he does have is one of the most remarkable track records of market crash predictions in modern finance. In 1999, while CNBC pundits were creating new metrics to justify stratospheric valuations, Hussman calmly identified the fundamental disconnects that would lead to the dot-com crash. Then, in 2007, as housing prices defied gravity, he methodically outlined how the bubble would burst. The financial world largely ignored him both times, preferring more optimistic narratives. When markets collapsed exactly as he'd forecasted, Hussman didn't take victory laps. He simply moved on to his next analysis, leaving the rest of us to wonder what warnings we might be ignoring today. 9. In 1925, when most politicians were celebrating Germany's seeming recovery from World War I, Winston Churchill was writing prophetic warnings. In articles and speeches, he laid out how the economic humiliation imposed on Germany would create fertile ground for a dictator. "The enormous changes have made the position of Germany in the world scarcely recognizable by the men who signed the Treaty of Versailles," he observed. Churchill specifically predicted the rise of a warrior figure who would channel economic grievances into military aggression. When Hitler rose to power 8 years later and began rearming Germany using exactly the economic playbook Churchill had outlined, few remembered the ignored warnings. Churchill's economic prediction wasn't just astute, it was a chilling demonstration of how financial forces shape political monsters. 10. The year was 1720. The Mississippi Company, backed by the French government, promised unprecedented wealth from American colonial trade. Investors trampled each other to buy shares, creating history's first true stock market bubble. Irish-French economist Richard Cantillon watched the mania with analytical calm. While others saw infinite riches, he identified the fatal flaw. There simply wasn't enough real economic activity to justify the valuations. Using economic theory that was centuries ahead of its time, Cantillon not only predicted the crash, but executed history's first documented short sale. He gradually liquidated his holdings, then borrowed shares to sell when prices peaked. When the bubble burst months later, exactly as he'd forecast, Cantillon had multiplied his fortune while France's economy lay in ruins. His 300-year-old playbook is still studied by hedge fund managers today. 11. At the 2005 Federal Reserve Conference in Jackson Hole, the economic equivalent of a celebrity retreat, Raghuram Rajan stepped to the podium and effectively told the room their party was about to end. The IMF's chief economist methodically explained how financial innovations were creating catastrophic systemic risk. In the audience, Larry Summers reportedly dismissed Rajan as a Luddite, while other luminaries rolled their eyes. The central bankers and financial elites were not about to let an academic rain on their deregulation parade. 3 years later, as Lehman Brothers collapsed and the global economy spiraled into the worst crisis since the Depression, Rajan's paper, "Has Financial Development Made the World Riskier?" read less like analysis and more like prophecy. Sometimes being the smartest person in the room means being the most ignored. 12. While the U.S. housing boom was reaching its frenzied peak in 2003, British economist Anne Pettifor was completing a manuscript with an ominous title, The Coming First World Debt Crisis. Her thesis was simple yet revolutionary. The combination of deregulated credit, securitization, and rampant consumerism had created a debt bubble of historic proportions. This credit bubble is unsustainable and will lead to an economic crisis similar to those that have afflicted emerging markets, she wrote. Financial reviewers dismissed her work as alarmist. 5 years later, as the global banking system imploded from excessive debt and toxic mortgage securities, Pettifor's prediction proved painfully accurate. Her reward, being largely excluded from the post-crisis commissions and inquiries, dominated by the very economists who had failed to see what she saw. 13. In 2005, Australian economist Steve Keen was teaching at the University of Western Sydney, far from Wall Street's power centers. Using complex debt-to-GDP models, he identified a catastrophic buildup of private debt that traditional economists were ignoring. Keen not only predicted the housing crash, but the precise mechanism that falling housing prices would trigger a deleveraging cycle, credit contraction, and economic collapse. Mainstream economists dismissed him as a fringe character with heterodox views. When global markets melted down exactly as he'd forecast, Keen was awarded the Revere Award for Economics for being the economist who most accurately predicted the crisis. The profession's response: continue to marginalize his views in favor of the same orthodox models that had failed so spectacularly. 14. In 1996, while Federal Reserve Chairman Alan Greenspan was wondering aloud about irrational exuberance, financial analyst James Grant was busy documenting exactly why the market's behavior was both irrational and dangerous. In his newsletter, Grant's Interest Rate Observer, and his book, The Trouble with Prosperity, Grant detailed how artificially low interest rates were fueling a speculative mania that would inevitably end in tears. We find ourselves at what may or may not prove to be the ultimate peak of the speculative frenzy, he wrote, with timing that would prove remarkable. The finance establishment, largely, ignored his warnings, preferring the soothing narratives of a new economy, immune to traditional valuation metrics. 4 years later, when the Nasdaq had shed 78% of its value, Grant's clinical analysis seemed less like opinion and more like clairvoyance. 15. In 1999, while mainstream economists were declaring the business cycle obsolete, economist Jörg G. Hulsmann was publishing a paper with a less popular thesis. His analysis of the post-1980 monetary regime led him to an inevitable conclusion. The stock market bubble would burst spectacularly. Hulsmann wasn't working with insider information or crystal balls, just Austrian economic theory and a willingness to challenge consensus. The financial establishment dismissed his warnings as pessimistic and theoretical. When markets collapsed shortly after, vindicating his analysis with painful precision, Hulsmann received no apologies from the profession that had mocked him. His case highlights an uncomfortable truth. Economic prophets are rarely honored in their own time, especially when their prophecies threaten institutional narratives about prosperity. 16. Between 1996 and 2000, while Wall Street analysts were tripping over themselves to predict ever higher stock valuations, a group of economists from the Austrian school were systematically documenting why the party would end in disaster. These scholars, marginalized in the profession and generally considered perpetual pessimists, produced paper after paper explaining how Federal Reserve policy was creating an unsustainable bubble. Their warnings appeared in obscure journals and niche publications, largely ignored by mainstream financial media. When the bubble burst exactly as they had predicted, there was no victory lap, no congressional testimony or lucrative consulting gigs. Instead, their vindication was quietly noted in the same obscure circles where their warnings had first appeared, a testament to how accurate economic forecasting often goes unrewarded in a profession that prizes optimism over accuracy. 17. As 2000 began, the stock market was reaching stratospheric heights, particularly in technology stocks. Gary Shilling, known for his permanently bearish outlook, stood virtually alone among mainstream forecasters in predicting an imminent recession. His analysis was simple yet devastating. The stock market crash that had already begun would trigger an economic contraction. When the Nasdaq dropped more than 30%, the writing was on the wall, he noted. Financial media dismissed his warning as more of the same from a perennial pessimist. By year's end, as the economy slid into exactly the recession he'd predicted, Shilling found himself in the uncomfortable position of being right when being wrong would have been much more popular. His case illustrates the peculiar economics of forecasting. Consistent accuracy often yields less influence than consistent optimism. 18. On March 25, 2000, as the Nasdaq approached its all-time peak, The Economist magazine published words that would prove prophetic. Such is the exuberance on Wall Street that only a brave man insists that the American stock market is overdue for a crash. Down the long history of bubbles ready to burst, it was ever thus. The article methodically dismantled the new economy argument supporting stratospheric valuations. What followed was one of the most perfectly timed market calls in publishing history. Within days, the market began a decline that would ultimately erase trillions in wealth. While individual analysts often get the credit or blame for market predictions, this case reminds us that sometimes institutions get it right, publishing the economic equivalent of a last call just before the lights come on and the party ends. 19. In 1993, demographic analyst Harry Dent published The Great Boom Ahead, a book that initially seemed wildly optimistic about America's economic prospects. But buried within his demographic models was a ticking time bomb, a prediction that consumer spending patterns would peak around 2008-2009 as baby boomers finished their high consumption years and began preparing for retirement. Demographics is destiny, Dent argued, showing how the age structure of the population drives economic cycles with mathematical precision. Mainstream economists dismissed his approach as overly simplistic. 15 years later, as global markets collapsed in the exact time frame Dent had identified, his demographic analysis suddenly seemed less like fortune-telling and more like actuarial science, a reminder that sometimes the most reliable crystal ball is a birth certificate. 20. Throughout the early 2000s, as markets recovered from the dot-com crash and housing prices soared to unprecedented heights, Swiss investor Mark Faber earned his nickname Dr. Doom by consistently predicting financial catastrophe. Month after month, his gloom, boom, and doom report warned of unsustainable bubbles across multiple asset classes. The financial media treated him as a curiosity, the perma-bear whose perpetual pessimism made for good television contrast but not serious investment advice. When markets finally did collapse in 2008, Faber's years of warnings suddenly looked less like paranoia and more like patience. His vindication raises an uncomfortable question for financial forecasters. Is being right years too early any better than being wrong? For Faber's clients who listened, the answer was a resounding yes. They preserved capital while others lost fortunes. 21. In 2004, hedge fund manager Whitney Tilson made what seemed like a safe contrarian bet. He publicly predicted Google's stock would be disappointing to investors following its IPO. His reasoning appeared sound. The company faced significant competition, regulatory risks, and a valuation that seemed detached from reality. The financial media gave his prediction serious consideration, given Tilson's track record. What followed was a spectacular demonstration of how even the most reasoned contrarian predictions can fail. Google's stock rocketed upward, delivering returns of over 900% in the following decade. Tilson's case stands as a humbling reminder that markets can sometimes defy both gravity and logic for much longer than seems possible, and that being contrarian is no guarantee of being correct. 22. In 2007, mathematician and former options trader Nassim Taleb published The Black Swan, a book warning that rare, unpredictable events have massive impacts that are rationalized only in retrospect. The book hit shelves just as cracks were appearing in the housing market. Taleb argued that financial models were dangerously flawed because they ignored these fat tail events. Wall Street, confident in its risk management systems, largely dismissed his concerns as philosophical musings rather than practical finance. Months later, as once-in-a-century financial events seemed to occur weekly, Taleb's framework suddenly became essential reading. His prediction wasn't about specific markets, but about our blindness to catastrophic risk, a meta-prediction about prediction itself. In proving him right, the financial crisis transformed Taleb from a quirky theorist to a reluctant prophet. 23. On October 15, 1929, America's most respected economist, Irving Fisher, delivered what would become the most infamous prediction in financial history. Stock prices have reached what looks like a permanently high plateau. Fisher wasn't some television pundit. He was Yale's sterling professor, whose contributions to economic theory are still taught today. His optimism was based on what seemed like solid analysis of productivity, innovation, and Federal Reserve policy. Exactly 9 days later, the market crashed, ultimately losing 89% of its value and helping trigger the Great Depression. Fisher himself lost his fortune and reputation. His case stands as the monument to forecasting hubris, a reminder that even brilliant minds armed with the best available data can mistake a precipice for a plateau when consensus and self-interest align. 24. In September 2010, with the global economy still reeling from the financial crisis, hedge fund manager David Tepper appeared on CNBC and made what seemed like a recklessly bullish call. His thesis was simple: either the economy would recover on its own, making stocks a good investment, or the Federal Reserve would flood the system with money, making stocks a great investment. "What's going to make the stock market go down?" he asked rhetorically. The financial community was skeptical, with many experts predicting a double-dip recession. What followed was one of the greatest market rallies in history, what traders now call the Tepper Rally. His prediction wasn't based on complex models, but on understanding the Federal Reserve's resolve, proving once again that in markets, sometimes the simplest analysis yields the most profitable insights. 25. In 1840, decades before either country had emerged as global powers, French political thinker Alexis de Tocqueville made an astonishing geopolitical forecast. In his seminal work, Democracy in America, he wrote, "There are now two great nations in the world which, starting from different points, seem to be advancing toward the same goal, the Russians and the Americans. Their starting point is different and their courses are not the same. Yet each seems marked by the will of heaven to sway the destinies of half the world." At the time, Russia was a backward empire and America a fledgling democracy. Neither remotely resembled the superpowers they would become. Yet Tocqueville's prediction materialized with eerie precision during the Cold War, a century later, demonstrating how sometimes the clearest crystal ball is simply deep historical perspective. 26. In 1783, as America was still establishing itself as an independent nation, Yale president Ezra Stiles delivered a remarkably precise demographic prediction. In a commencement address, he forecast that the United States population would reach 300 million in 200 years. Using European growth patterns and factoring in America's vast territory, Stiles calculated a growth trajectory that seemed fantastical to his contemporaries. The young nation had barely 3 million inhabitants at the time. Yet his prediction proved startlingly accurate. The U.S. population hit 300 million in 2006, just 23 years beyond his projected timeline. What makes Stiles' forecast particularly impressive isn't just its numerical precision, but that it came before modern statistical methods. His case reminds us that sometimes the best predictions come not from complex models, but from simple pattern recognition applied with disciplined thinking. 27. In the December 1900 issue of Ladies' Home Journal, civil engineer John Elfrith Watkins published What May Happen in the Next 100 Years. Among his predictions, photographs will reproduce all of nature's colors and be transmitted by electricity from any distance. Remember, this was written when photography meant glass plates and chemicals, decades before even black and white television. Watkins essentially described digital photography and instant image transmission a century before Instagram. The scientific establishment largely dismissed his article as fanciful speculation. The technical challenges seemed insurmountable given period technology. Yet by the early 2000s, his prediction had materialized with almost perfect accuracy, demonstrating how extrapolating from technical principles can sometimes yield more accurate forecasts than focusing on specific implementation details. 28. In his 1968 novel 2001: A Space Odyssey, Arthur C. Clarke described devices called news pads that astronauts used to read news from Earth. The text was updated automatically on every hour. One could spend an entire lifetime doing nothing but absorbing the ever-changing flow of information from the news satellites. Clarke's description wasn't just vaguely similar to modern tablets, it precisely described their form, function, and social impact, 42 years before Apple released the iPad. The technology industry largely ignored science fiction as a serious source of product innovation, preferring market research and focus groups. Clarke's case demonstrates how sometimes the most accurate technological forecasts come not from industry experts, but from those who understand how humans naturally want to interact with information. 29. In his 1953 novel Fahrenheit 451, Ray Bradbury described a world where people walked around with little seashells, thimble radios that brought an electronic ocean of sound, of music, and talk directly into their ears. Remember, this was written when portable music meant bulky transistor radios decades before even the Sony Walkman. Bradbury not only predicted wireless earbuds with perfect accuracy, but also foresaw how they would transform society by enabling constant audio consumption. Engineers at the time would have dismissed his vision as fantasy. The miniaturization challenges alone seemed insurmountable. Yet by the 2010s, Apple AirPods and similar devices had made Bradbury's prediction reality, proving once again that the best technological forecasts often come from those who understand human desires rather than technical specifications. 30. In a 1988 interview with Bill Moyers, when the internet was still primarily a military and academic network, science fiction author Isaac Asimov described a revolutionary educational future. Once we have computer outlets in every home, each of them hooked up to enormous libraries. You can ask a question and be answered. You can follow up a course in your own time, at your own speed. Everyone can have a teacher in the form of access to the gathered knowledge of the human species. Technologists at the time were focused on hardware challenges, largely missing the social transformation Asimov described. 3 decades later, as online courses, Wikipedia, and search engines made his vision reality, Asimov's prediction stands as a testament to how literary imagination sometimes sees further than technical expertise. 31. In 1993, when most Americans had never been online and mobile phones resembled bricks, AT&T launched its You Will television campaign. The commercials asked viewers, "Have you ever sent a fax from the beach? You will. Have you ever paid a toll without slowing down? You will." The ads predicted video calls, telemedicine, GPS navigation, on-demand streaming, and touchscreen tablets, technologies that wouldn't become mainstream for another decade or more. What made these predictions remarkable wasn't just their accuracy, but their source. They came from a corporate marketing department, not futurists or science fiction. AT&T's case demonstrates how sometimes the clearest view of the future comes not from dreaming about what might be possible, but from carefully analyzing what's already in development pipelines. 32. In 1865, while the American Civil War was ending and mechanical calculators were still novelties, Jules Verne published From the Earth to the Moon. His story described a lunar mission with uncanny precision, a three-person crew launching from Florida in an aluminum capsule, experiencing weightlessness and using retro rockets. Verne even correctly calculated the escape velocity needed. Contemporary scientists dismissed the work as pure fantasy. Yet, 104 years later, when Apollo 11 fulfilled Verne's vision with startling fidelity, NASA scientists acknowledged their debt to his imagination. His case stands as perhaps the most remarkable technological prediction in literature, not merely anticipating a development, but describing its specific implementation with accuracy that would make modern futurists envious. 33. In 1909, celebrated author Mark Twain made a morbid yet precise prediction about his own death. "I came in with Halley's Comet in 1835. It is coming again next year, and I expect to go out with it," he told his biographer. Twain was referring to the fact that he was born during the comet's previous appearance and anticipated dying during its return. The prediction seemed like classic Twain humor. How could anyone time their death to an astronomical event? Yet on April 21, 1910, Twain died of a heart attack just one day after the comet's closest approach to Earth. The astronomical coincidence transformed what might have been dismissed as a witty quip into one of history's most personal and precise predictions, demonstrating how sometimes even the most improbable forecasts materialize with eerie accuracy. 34. In 1898, 14 years before the RMS Titanic sank, novelist Morgan Robertson published a novella titled Futility, or The Wreck of the Titan. It described an unsinkable British ocean liner called Titan that strikes an iceberg in the North Atlantic on its April maiden voyage and sinks with massive loss of life due to insufficient lifeboats. The similarities to the actual Titanic disaster weren't just general. Robertson correctly predicted specific details, including the ship's size, speed, and structural features. Maritime experts of the time would have dismissed his scenario as implausible, given the engineering advances of the era. When reality mirrored fiction with chilling precision 14 years later, Robertson's work transformed from obscure fiction to prophetic warning, demonstrating how sometimes storytellers see dangers that engineers miss. 35. You know that moment when you're playing with blocks as a kid and suddenly create a perfect tower? That's essentially what happened in 1869 when Russian chemist Dmitry Mendeleev dreamt up the periodic table of elements. But Mendeleev didn't just organize the known elements. He left deliberate gaps for elements that hadn't been discovered yet, predicting their properties with almost supernatural precision. When germanium was discovered in 1886, scientists were dumbfounded to find it matched Mendeleev's ecosilicon prediction down to its specific gravity and atomic weight. The scientific establishment, initially skeptical of his mystical arrangement, was forced to acknowledge that sometimes the right framework reveals truths that aren't yet visible. Mendeleev's triumph stands as a reminder that the most powerful predictions don't just tell us what will happen. They give us a system to understand why. 36. Ever gone to a psychic who tells you something so vague it could apply to literally anyone? You will meet someone important, or money matters will require attention. That's essentially Nostradamus's entire brand. In the 16th century, the French apothecary published collections of quatrains so ambiguous they could be retrofitted to almost any historical event. His predictions have been confirmed for everything from Hitler's rise to 9/11, after the fact, of course. Yet despite their vagary, or perhaps because of it, Nostradamus's prophecies have remained in circulation for 5 centuries. His case represents prediction's evil twin. If you make forecasts fuzzy enough and throw in some astrological jargon, you don't need accuracy, just gullibility and confirmation bias. The Nostradamus industry, still thriving today, proves that in prediction markets, mystique can sometimes be more profitable than mathematics. 37. While Victorian gentlemen were building mechanical calculators for arithmetic, Ada Lovelace was envisioning something far more radical. In 1843, working with Charles Babbage on his analytical engine, Lovelace penned what many consider the first computer algorithm. But her true prescience came when she wrote that computers would not be limited to numbers. They would manipulate symbols to compose music and create art. Her male contemporaries dismissed this as feminine fancy, insisting machines would forever remain glorified calculators. Over 170 years later, as AI systems compose symphonies and generate artwork, Lovelace's prediction stands as perhaps the earliest and most profound insight into computing's creative potential. Her vision reminds us that the true prophets of technology aren't those who extrapolate existing trends, but those who imagine entirely new relationships between humans and machines. 38. In 1968, while America was electing Richard Nixon and fighting in Vietnam, science fiction author John Brunner sat down to imagine 2010. In his novel Stand on Zanzibar, Brunner described a world led by President Obomi, where terrorism plagued America, Detroit was a wasteland, and people had devices that could pause and rewind TV. The technological details were eerie enough, but predicting a president with a name phonetically similar to Obama 40 years before his election. That's the kind of coincidence that makes statisticians uncomfortable. Critics have pointed out that Brunner's Obomi led an African nation, not America, but the collection of accurate predictions remains unsettling. Brunner's case shows how fiction writers, freed from the constraints of academic rigor, sometimes stumble into forecasting accuracy that formal futurists can only envy. A cosmic joke at the expense of professional prognosticators. 39. In 1914, while Europe marched toward conventional war with trenches and machine guns, H.G. Wells was envisioning a far more terrifying weapon. His novel, The World Set Free, described bombs that released the energy locked inside atoms, creating explosions that continued for days. Wells even coined the term atomic bombs. Physicists at the time knew of radioactivity, but considered the energy release too slow to be weaponized. 3 decades later, as the Manhattan Project scientists worked to harness nuclear fission, many acknowledged their debt to Wells's imagination. The novelist had not only predicted the concept, but accurately forecasted the weapon's strategic impact and the existential crisis it would create. Wells's atomic prophecy reminds us that sometimes fiction writers, unconstrained by current technological limitations, can see further ahead than the scientists working within them. 40. During a 1987 televised forum on the future of cinema, film critic Roger Ebert made a prediction that caused the Hollywood executives present to stare in disbelief. He described a system where movies will come into homes like running water, allowing viewers to select films from vast libraries and watch them on demand. This was a time when VHS rental stores were considered cutting edge and broadband internet didn't exist. The studio heads dismissed his vision as economically impossible. Who would build the infrastructure? 2 decades later, as Netflix and other streaming services transformed how we consume media, Ebert's forecast proved remarkably accurate. His case demonstrates how sometimes industry outsiders can see the future of a business more clearly than those running it, precisely because they're not constrained by current economic models and sunk costs. 41. You have to love a guy who goes toe-to-toe with Thomas Edison. In 1926, inventor Nikola Tesla told the New York Times something that sounded like science fiction. It will soon be possible to transmit wireless messages all over the world so simply that any individual can carry and operate his own apparatus. Remember, this was when radio required massive receivers and telephones were tethered to walls. Engineers scoffed at the impracticality of Tesla's vision. The power requirements and miniaturization challenges seemed insurmountable. 6 decades later, as the first cellular networks went live and mobile phones began shrinking from briefcase-sized to pocket-sized, Tesla's prediction revealed itself as remarkably prescient. His wireless vision reminds us that true technological prophets don't just imagine better versions of existing tools. They anticipate how technology will fundamentally reshape our relationship with the world. 42. Sometimes the universe has a dark sense of humor. In 1993, The Simpsons aired an episode featuring fictional German entertainers Gunther and Ernst, who performed with white tigers until one attacked them mid-show. 10 years later, in a Las Vegas casino, Roy Horn of Siegfried and Roy was mauled by one of his white tigers during a live performance, in a manner eerily similar to the cartoon. The show's writers have insisted it was simply a predictable joke about exotic animal acts. What else might happen when performing with predators? Yet the specific parallels between the animated gag and the real-life tragedy left even skeptics unnerved. While likely just a darkly prophetic coincidence, the case illustrates how satire sometimes inadvertently predicts reality not through mystical insight, but by following the logical conclusion of existing situations to their natural, if unfortunate, endpoints. 43. In a throwaway joke from a March 2000 episode, The Simpsons depicted a future where Lisa Simpson becomes president, mentioning she's inherited quite a budget crunch from President Trump. At the time, Donald Trump was a real estate developer and reality TV personality with no political experience. The idea of him becoming president was played strictly for laughs. 16 years later, when Trump won the 2016 election, the clip went viral, earning the show a reputation for prophetic satire. The writers have explained it was simply a logical extension of Trump's periodic flirtations with presidential runs, a case of comedic extrapolation rather than clairvoyance. Nevertheless, the prediction stands as a reminder that satirists, whose job requires them to identify absurd possibilities within current trends, sometimes accidentally become forecasters when reality follows comedy's lead. 44. Back when the internet was still primarily used by academics and the military, Bill Gates was already seeing its commercial potential with startling clarity. In 1995, while most people were still figuring out what online meant, Gates wrote about a future where people would create private websites for friends and family to share news, essentially predicting Facebook a decade early. He described smart advertising based on purchasing patterns in online job-seeking platforms like today's LinkedIn. Critics dismissed his vision as self-serving hype from a software monopolist. 2 decades later, as social media transformed communication and e-commerce became ubiquitous, Gates's predictions proved remarkably prescient. His foresight reminds us that sometimes the most accurate technological forecasts come not from independent futurists, but from those with the deepest understanding of existing infrastructure and its logical evolution. 45. Every awkward sleepover you've experienced on a waterbed can be blamed, at least partially, on Robert Heinlein. In his 1961 novel Stranger in a Strange Land, Heinlein described hydraulic beds that conform to the body for perfect comfort. An industrious reader, Charles Hall, was so inspired that he created the first commercial waterbed in 1968. But Heinlein's prescience didn't stop there. The same novel accurately predicted personal computers in typical homes, which wouldn't become reality for another 2 decades. Science fiction authors typically get categorized as entertainers rather than serious futurists, yet their track record often surpasses that of professional forecasters. Heinlein's case demonstrates how fiction, freed from the constraints of current technology and existing business models, sometimes sees further than formal prediction methods, a reminder that imagination can be as powerful a forecasting tool as extrapolation. 46. In 1968, when computers were room-sized machines requiring punch cards, director Stanley Kubrick showed astronauts in 2001, A Space Odyssey, casually using flat rectangular devices that looked suspiciously like iPads. These newspads displayed dynamic content and responded to touch, features that wouldn't exist in consumer devices for another 4 decades. The resemblance was so striking that when Apple launched the iPad in 2010, tech journalists immediately referenced Kubrick's prediction. What made this forecast particularly remarkable was that it came from a filmmaker, not a computer scientist or engineer. Kubrick's vision reminds us that sometimes the most accurate technological predictions emerge not from technical expertise, but from a deep understanding of human behavior and needs. We wanted portable information tablets long before we could build them. 47. While America was grooving to Sgt. Pepper's Lonely Hearts Club Band in 1967, Philco Ford released a short film called 1999 AD, depicting a futuristic smart home that would make today's tech bros swoon. It featured video calls, online shopping, electronic bill payment, and push-button meal preparation, all controlled from a central computer. Engineers at the time considered it fantasy. The processing power and networks required seemed decades beyond reach. Yet by the actual 1999, and certainly by today, virtually every technology in the film had become reality. What's fascinating isn't just the technological foresight, but the social prediction. The film accurately anticipated how digital convenience would reshape domestic life. The case stands as a reminder that the best technological predictions consider not just what will be possible, but how those possibilities will integrate into everyday human experience. 48. In a 2006 episode of the medical comedy Scrubs, the janitor character made a throwaway remark, "In my opinion, we should be looking for bin Laden in Pakistan." 5 years later, U.S. Navy SEALs found and killed Osama bin Laden in, you guessed it, Abbottabad, Pakistan. Show writers have insisted it wasn't special intelligence but simple logic. Pakistan was always a likely hiding spot given bin Laden's network and the country's complex relationship with extremism. Nevertheless, while military and intelligence professionals publicly focused on Afghanistan and other locations, a TV comedy writer somehow got it right. The case reminds us that prediction isn't always about specialized knowledge or complex models. Sometimes it's about stepping back from institutional groupthink and considering the most logical possibilities without political or bureaucratic constraints. 49. When comedy winks at the universe, sometimes the universe winks back. In 2006, a Saturday Night Live sketch featured a fake advertisement for O.J. Simpson's book titled "If I Did It, Here's How," a satirical jab at the acquitted former football star. The joke was that even Simpson wouldn't be brazen enough to write a hypothetical confession. The studio audience laughed at the absurdity. Then, just weeks later, reality matched parody when news broke that Simpson had actually written a book titled "If I Did It," describing how he would have committed the murders if he had done it. The book was pulled after public outcry, but eventually published to benefit the victims' families. SNL's case demonstrates how satire sometimes predicts reality not through clairvoyance, but by identifying and exaggerating the logical extension of existing situations, even when that extension seems too absurd to actually happen. 50. While filming a music video on Wall Street in 1999, Rage Against the Machine captured something unintentionally prophetic. In footage of the crowd gathered to watch the shoot, a man can be seen holding a sign reading, "Donald J. Trump for President 2000. The band, known for anti-establishment politics, likely saw it as an ironic counterpoint to their message. Trump represented exactly the wealth concentration they criticized. Neither the band nor the sign holder could have known that 17 years later, Trump would indeed become president, though not in 2000. While technically an inaccurate prediction about the timing, the sign's existence years before Trump's political career became serious stands as a bizarre time capsule, either an extraordinarily lucky guess or evidence that some saw Trump's political ambitions as viable long before the political establishment did. 51. When Warren Buffett speaks, markets listen. But the Oracle of Omaha's most prescient contribution might be a simple ratio that most investors overlooked until too late. Buffett developed what's now called the Buffett indicator, total stock market capitalization divided by GDP, as a measure of whether markets are overvalued. When the indicator exceeded 100% before the dot-com crash and again before 2008, Buffett quietly reduced his equity exposure. Financial media, caught up in bull market euphoria, paid little attention to this metric. When both bubbles burst precisely as the indicator had warned, the investment community suddenly discovered the Buffett indicator, which now gets tracked obsessively. Buffett's case illustrates how the most valuable predictive tools are often hiding in plain sight, not complex algorithms or esoteric theories, but simple ratios that capture fundamental economic relationships that can't be violated forever. 52. In 1934, while America was still climbing out of the Great Depression, Benjamin Graham published Security Analysis, a book that would transform how markets value companies. Graham proposed that investors should ignore market hysteria and instead focus on measurable fundamentals like assets, earnings, and dividends. Financial professionals, still shell-shocked from the 1929 crash, were skeptical that any systematic approach could work in what seemed like a casino. Graham's most famous student, Warren Buffett, would prove them wrong by building one of history's greatest fortunes using these principles. But Graham's deeper prediction, that markets would eventually recognize the superiority of fundamental analysis, took decades to materialize. Today, as quantitative models scan for value factors that Graham identified nearly a century ago, his methodical approach stands vindicated, proving that sometimes the most powerful financial predictions aren't about specific events, but about how markets ultimately think. 53. In 1936, as global economies still reeled from depression, John Maynard Keynes introduced a concept that would revolutionize how we understand markets. In The General Theory, Keynes described how animal spirits, essentially human psychology, drive economic decisions more than rational calculations. Traditional economists scoffed, insisting markets were rational mechanisms. Decades later, as behavioral economics emerged to explain market phenomena that traditional models couldn't, Keynes's insight proved revolutionary. His prediction wasn't about a specific event, but something deeper, that psychological factors like confidence, fear, and herding behavior would become essential to understanding markets. Today, central banks carefully manage market psychology, and sentiment indicators are tracked as closely as hard economic data, a testament to Keynes's foresight in recognizing that economies are ultimately human systems subject to human irrationality. 54. In the early 1970s, while Wall Street traders were still using intuition and gut feeling to price options, two academics were developing a mathematical model that would transform finance. Fisher Black and Myron Scholes created an equation to determine the theoretical price of options, publishing their work in 1973. The financial industry initially dismissed it as ivory tower abstraction, too mathematical for practical trading. Within a decade, however, the Black-Scholes model became the foundation of a derivatives market that would grow to hundreds of trillions of dollars. Their prediction wasn't just about option pricing, but about how quantitative methods would revolutionize finance. Today, as algorithms execute most trades and quants dominate Wall Street, the Black-Scholes revolution stands as one of the most transformative predictions in financial history, proving that sometimes a single equation can reshape an entire industry. 55. In 1970, when stock pickers reigned supreme and actively managed mutual funds were the gold standard of investing, economist Eugene Fama published a radical theory. His efficient market hypothesis claimed that stock prices already reflect all available information, making consistent market-beating returns impossible. Fund managers and financial advisors were outraged. Fama was essentially calling their entire profession futile. 5 decades later, as study after study has shown that the vast majority of active managers underperform their benchmarks over time, Fama's prediction has been largely vindicated. His work laid the theoretical foundation for index investing, now a multi-trillion-dollar industry. Fama's case illustrates how some of the most valuable financial predictions aren't flashy calls about market direction, but fundamental insights about market structure, ideas that initially face fierce resistance precisely because they threaten established interests. 56. In 1952, when investors still built portfolios by picking stocks they liked or had heard good things about, a 25-year-old graduate student named Harry Markowitz published a paper that would eventually earn him a Nobel Prize. Markowitz proposed a mathematical framework showing how diversification could reduce risk without sacrificing returns. Wall Street veterans dismissed his work as academic theory disconnected from real markets. 7 decades later, modern portfolio theory forms the backbone of almost all institutional investing. Every target date retirement fund, every robo-advisor, and every pension allocates assets based on Markowitz's insights. His prediction wasn't about market direction, but about the fundamental nature of risk and return, a framework that transformed investing from an art to a science. The case demonstrates how sometimes the most powerful predictions aren't about specific events, but about conceptual frameworks that reshape how an entire field operates. 57. In 1973, when stockbrokers charged exorbitant fees and investment advice was treated like secret wisdom, economist Burton Malkiel published A Random Walk Down Wall Street. His provocative thesis, stock prices follow a random walk pattern that makes prediction impossible, and most investors would be better off with simple index funds. Wall Street professionals were outraged. Malkiel was attacking their very livelihood. 5 decades later, passive index funds have grown to trillions in assets and consistently outperformed most active managers. Malkiel's prediction has been vindicated. His work helped launch the index fund revolution that has democratized investing and saved consumers billions in fees. The case demonstrates how sometimes the most valuable financial predictions aren't about market direction, but about investment philosophy, ideas that initially face fierce resistance precisely because they threaten powerful financial interests. 58. In the 1970s, when junk bonds were considered untouchable and companies with less than perfect credit struggled to raise capital, Michael Milken saw an opportunity that would transform corporate finance. The Drexel Burnham Lambert banker predicted that high-yield bonds from riskier companies could deliver superior returns if properly analyzed and diversified. The financial establishment was skeptical. These were fallen angels for a reason. Milken proved them wrong, creating a market that grew from practically nothing to hundreds of billions, financing the growth of companies from MCI to Turner Broadcasting. Though his career ended in disgrace with securities violations, Milken's market prediction was prescient. Today, high-yield bonds are a mainstream asset class held by pension funds and mutual funds worldwide. His case demonstrates how sometimes the most transformative financial predictions aren't about market direction, but about creating entirely new markets that the establishment never imagined could exist. 59. In 1979, as America struggled with double-digit inflation that seemed impossible to tame, newly appointed Federal Reserve Chairman Paul Volcker made a prediction that shocked both markets and politicians. He declared that dramatically raising interest rates, effectively inducing a recession, was the only way to break inflation's back. The economic establishment was skeptical, and politicians were horrified at the prospect of deliberately causing economic pain. Volcker held firm, raising the federal funds rate to an unprecedented 20%. The resulting recession was indeed severe, but by 1983, inflation had fallen from 13.5% to 3.2%, vindicating Volcker's controversial forecast. His case demonstrates how sometimes the most valuable economic predictions aren't about identifying problems, but about prescribing unpopular solutions and having the courage to implement them despite fierce opposition from those who prioritize short-term relief over long-term stability. 60. In 1975, when active management was gospel and stock picking was considered an art form requiring genius, Vanguard founder John Bogle launched the first retail index fund. His prediction was simple, yet revolutionary. Most actively managed funds would underperform the market after fees, making low-cost passive investing the superior strategy for most people. The financial industry mocked his innovation as Bogle's folly and un-American. Who would settle for average? 4 decades later, as index funds have grown to trillions in assets and consistently outperformed most active managers, Bogle's prediction has been thoroughly vindicated. His case demonstrates how sometimes the most valuable financial predictions aren't about market direction, but about investment philosophy. Ideas that initially face fierce resistance precisely because they threaten established business models and professional identities in finance. 61. In the early 1990s, while most economists were puzzling over sluggish productivity growth despite massive technology investments, Federal Reserve Chairman Alan Greenspan made a contrarian prediction. He claimed that technology would drive a productivity boom, justifying higher stock valuations and allowing faster growth without inflation. The economic establishment was skeptical. The productivity paradox had persisted for years. By mid-decade, Greenspan was proved right as productivity surged, enabling the longest economic expansion in U.S. history. His technological optimism allowed him to keep interest rates lower than conventional models suggested was prudent. Greenspan's technology prediction was remarkably prescient, even if his later forecasts about housing weren't. His case demonstrates how sometimes the most valuable economic predictions come not from complex models, but from identifying fundamental shifts in how economies function, insights that can emerge from careful observation of microeconomic changes before they appear in aggregate statistics. 62. In the 1990s, as tech companies with little revenue commanded eye-popping valuations, technology writer George Gilder provided the intellectual framework to justify the seemingly irrational exuberance. Applying Metcalfe's law, which states that a network's value grows with the square of its users, Gilder predicted that internet companies would create unprecedented value through network effects. Traditional value investors scoffed, pointing to non-existent earnings and astronomical price-to-sales ratios. 2 decades later, as companies like Facebook, Google, and Amazon have leveraged network effects to become some of the most valuable enterprises in history, Gilder's application of Metcalfe's law appears prescient. His case demonstrates how sometimes the most valuable technological predictions come not from inventing new frameworks, but from correctly applying existing principles from one domain, telecommunications networks, to another, internet businesses, recognizing patterns that traditional analysts miss. 63. In 1997, as established companies were dismissing internet upstarts as insignificant threats, Harvard professor Clayton Christensen published The Innovator's Dilemma. His prediction was counterintuitive. Well-run incumbent companies would be systematically disrupted not because of poor management, but because of good management. Their focus on current customers and existing business models would blind them to disruptive innovations. Business leaders were skeptical. Surely good companies could adapt. 2 decades later, as Netflix destroyed Blockbuster, Amazon decimated bookstores, and Uber upended taxis, Christensen's disruption theory has been vindicated repeatedly. His prediction wasn't about specific companies, but about the pattern of disruption itself, a framework that helps explain why market leaders so often fail to maintain their dominance when technologies change. The case demonstrates how sometimes the most valuable business predictions identify systemic patterns rather than specific events. 64. In 1980, when business strategy was often reduced to simplistic goals like grow market share, Harvard professor Michael Porter published Competitive Strategy, introducing a framework that would revolutionize how companies think about competition. Porter predicted that sustainable competitive advantages would come from just 3 sources: cost leadership, differentiation, or focus. Business leaders were initially skeptical of this reductionist approach. Surely strategy was more nuanced. 4 decades later, Porter's framework has become the foundation of strategic thinking in corporations worldwide. His prediction wasn't about specific companies or industries, but about the fundamental nature of competitive advantage itself, a conceptual model that helps explain why some companies consistently outperform others. The case demonstrates how sometimes the most valuable business predictions aren't about market trends, but about clarifying the timeless principles that govern competition regardless of industry or era. 65. In 1959, when factory workers still dominated the American labor force, management guru Peter Drucker coined a term that would define the future economy: Knowledge worker. Drucker predicted that mental labor would replace physical labor as the economic center of gravity, creating a fundamentally different kind of workforce with different needs and motivations. Business leaders focused on managing the industrial economy paid little attention. 6 decades later, as knowledge workers dominate the economy and companies compete fiercely for intellectual talent, Drucker's prediction seems almost obvious in retrospect. His insight wasn't just about employment categories, but about how the entire relationship between capital and labor would transform when the most valuable assets could walk out the door. The case demonstrates how sometimes the most valuable economic predictions identify fundamental shifts in the nature of work itself, changes that happen gradually but ultimately reshape the entire economic landscape. 66. In 1970, when most Americans still got their news from 3 television networks and worked for the same company for decades, futurist Alvin Toffler published Future Shock. His prediction was unsettling. Accelerating technological change would overwhelm people. Psychologically, creating a state of information overload and constant adaptation stress. Critics dismissed his concerns as alarmist. Humans had always adapted to change. 5 decades later, as people struggle with digital addiction, constant connectivity, and the psychological impact of social media, Toffler's prediction seems prophetic. His insight wasn't just about technology, but about humans' limited capacity to process and integrate rapid change. The case demonstrates how sometimes the most valuable futurist predictions focus not on the technologies themselves, but on their psychological and social impacts, the human dimension that technical forecasts often overlook. 67. In 1962, when television was still a novelty in many homes and international phone calls required operator assistance, media theorist Marshall McLuhan predicted that electronic media would create a global village where information would flow instantly worldwide. Communication experts focused on existing technologies and business models dismissed his vision as utopian. 6 decades later, as social media connects billions in real time and events in one country instantly trigger reactions worldwide, McLuhan's global village has become our reality. His insight wasn't just about technology, but about how instant global communication would fundamentally reshape human consciousness and social organization. The case demonstrates how sometimes the most valuable media predictions identify not just technological possibilities, but their transformative effects on human experience. Changes that happen gradually, but ultimately reshape how we perceive ourselves and our relationship to the world. 68. In the 1960s, when bigger was still considered better in most industries, architect and futurist Buckminster Fuller predicted that technology would increasingly allow humanity to do more with less, what he called ephemeralization. Engineers and business leaders, trained to think in terms of economies of scale, were skeptical of this counterintuitive claim. 6 decades later, as smartphones replace dozens of separate devices and apps, create billion-dollar companies with minimal physical infrastructure, Fuller's prediction has been dramatically vindicated. His insight wasn't just about miniaturization, but about the fundamental trajectory of technological evolution toward greater efficiency. The case demonstrates how sometimes the most valuable technological predictions identify not just specific innovations, but the underlying patterns that drive multiple waves of innovation across different domains, principles that may seem abstract, but ultimately reshape the material world we inhabit. 69. In the 1960s, when most strategic planning involved single-point forecasts and linear projections, Rand Corporation analyst Herman Kahn pioneered a revolutionary approach, scenario planning. Rather than trying to predict the future, Kahn advocated developing multiple possible futures to test strategy against. Military and corporate leaders, accustomed to definitive answers, were initially skeptical of this seemingly indecisive method. 6 decades later, scenario planning has become a standard practice at forward-thinking organizations worldwide, from Royal Dutch Shell to the Pentagon. Kahn's meta-prediction that traditional forecasting would prove inadequate for complex systems has been vindicated repeatedly, as single-point predictions fail in the face of deep uncertainty. The case demonstrates how sometimes the most valuable predictive innovations aren't better crystal balls, but better frameworks for acknowledging and managing uncertainty, approaches that sacrifice false precision for genuine robustness. 70. You're walking down your city street today, probably passing the kind of neighborhood Jane Jacobs fought for. In 1961, when urban planners were busy bulldozing vibrant city blocks to build sterile housing projects and superhighways, Jacobs published The Death and Life of Great American Cities. Her revolutionary prediction, diverse mixed-use neighborhoods with eyes on the street would prove more economically viable than modernist planned developments. City officials and professional planners dismissed her as an amateur housewife meddling in men's work. 6 decades later, as once declining urban neighborhoods have revitalized following exactly the principles Jacobs outlined, her economic vision has been thoroughly vindicated. Property values in walkable mixed-use areas now command premium prices, while many of the urban renewal projects she opposed have been demolished. Her insight reminds us that economic value often emerges from organic human connections rather than top-down planning. 71. In 1972, when computers were mainframe behemoths tended by white-coated technicians, Whole Earth Catalog founder Stuart Brand published an article in Rolling Stone with a revolutionary prediction. Computers would become personal tools for creativity and liberation. Ready or not, he wrote, computers are coming to the people. The tech establishment thought he was hallucinating. Computers were serious business machines, not toys for hippies. A decade later, as the first personal computers appeared in homes and schools, Brand's countercultural vision began materializing. 2 decades later, as digital tools democratized everything from publishing to music production, his forecast proved remarkably prescient. Brand's prediction wasn't just about technology, but about power, that computation would shift from institutions to individuals, creating entirely new economies and forms of expression. His case illustrates how sometimes the most valuable predictions come from cultural visionaries who see beyond technical specifications to the human implications. 72. In 1997, while most business strategists were still thinking in industrial age terms, Wired magazine co-founder Kevin Kelly published New Rules for the New Economy. His central prediction, network effects would become the dominant force in business, creating winner-take-all dynamics where the best-connected player captures nearly all value. Traditional economists dismissed his framework as tech hype. Surely normal competitive forces would prevail. 2 decades later, as companies like Facebook, Amazon, and Google have leveraged network advantages to achieve unprecedented market dominance, Kelly's analysis seems prophetic. His prediction wasn't just about specific companies, but about a fundamental shift in how economic value is created and captured in connected systems. The case demonstrates how sometimes the most valuable economic predictions come not from analyzing existing markets, but from identifying the entirely new economic laws that will govern future ones. Systemic insights that explain why digital economics functions differently than industrial economics. 73. In April 2000, as tech stocks were beginning their historic crash, Sun Microsystems co-founder Bill Joy published an essay in Wired that chilled the techno-optimism of Silicon Valley. Titled, Why the Future Doesn't Need Us, Joy predicted that accelerating progress in genetics, nanotechnology, and robotics would create unprecedented existential risks to humanity. His peers in tech dismissed the warning as alarmist. Technology had always brought more benefits than harms. 2 decades later, as AI safety concerns have gone mainstream and synthetic biology capabilities raise global biosecurity alarms, Joy's framework for understanding technological risk seems remarkably foresighted. His prediction wasn't just about specific technologies, but about how the convergence of multiple accelerating technologies could create risks beyond our ability to manage them. Upon analytical reflection, Joy's case illustrates how sometimes the most valuable technological predictions come from insiders who understand not just what's possible, but what's prudent. 74. In 1999, inventor Ray Kurzweil published The Age of Spiritual Machines, containing a prediction that most AI experts considered absurd. Artificial intelligence would match and ultimately surpass human capabilities within a few decades, driven by exponential improvements in computing power. The AI establishment, suffering through what would become known as the AI winter, dismissed Kurzweil as a technological utopian detached from the hard realities of the field. 2 decades later, as AI systems compose music, generate art, write coherent text, and defeat champions at complex games, Kurzweil's exponential forecasting methodology has proven remarkably accurate. His predictions weren't just about specific capabilities, but about the accelerating pace of change itself. The case demonstrates how sometimes the most valuable technological predictions come not from focusing on current limitations, but from recognizing the mathematical patterns that govern technological evolution, curves that often outpace our intuitive linear thinking about the future. 75. In 1995, when most people were just discovering email and the web, MIT Media Lab founder Nicholas Negroponte published Being Digital with a deceptively simple prediction. The world would undergo a fundamental transformation as atoms were replaced by bits in many products and services. Business leaders, still focused on physical goods and traditional distribution channels, largely missed the significance of this shift. 3 decades later, as digital products have transformed industries from music to books to banking, Negroponte's atomic-to-bits framework seems almost self-evident. His prediction wasn't just about specific technologies, but about a fundamental shift in the nature of economic value, from scarcity to abundance, from physical to virtual. The case demonstrates how sometimes the most valuable predictions identify not just specific trends, but conceptual frameworks that help make sense of entire epochs of economic and technological change, lenses that bring the future into clearer focus. 76. In 1997, when most internet users were still celebrating the liberating potential of digital technologies, technology analyst Esther Dyson sounded a prescient warning. In her book Release 2.0, Dyson predicted that internet growth would create unprecedented privacy challenges, requiring new regulatory frameworks and ethical standards. Silicon Valley leaders, riding high on digital utopianism, largely dismissed her concerns as pessimistic. 2 decades later, as data breaches, surveillance scandals, and algorithmic bias have become regular headlines, Dyson's early analysis seems remarkably foresighted. Her prediction wasn't just about specific privacy issues, but about the fundamental tension between technological capability and human values in digital systems. With a touch of ironic wit, we might observe that Dyson's case demonstrates how sometimes the most valuable technological predictions come not from cheerleaders, but from thoughtful skeptics who ask not just what technology can do, but what it should do. 77. In 1996, as governments were beginning to grapple with regulating the internet, Electronic Frontier Foundation co-founder John Perry Barlow published A Declaration of the Independence of Cyberspace. His provocative prediction, the internet would operate beyond traditional government control, creating a space where old power structures couldn't function. Government officials dismissed this as techno-libertarian fantasy. Surely sovereign states would maintain authority. 3 decades later, as governments still struggled to effectively regulate digital spaces and encrypted communications, Barlow's vision has proven partly accurate. While not the regulation-free utopia he imagined, the internet has indeed created governance challenges that traditional authority structures struggle to address. His prediction wasn't just about specific policies, but about a fundamental shift in the relationship between geography and authority. The case demonstrates how digital technologies have created jurisdictional and enforcement complexities that continue to reshape the landscape of power. 78. In 1989, while working at CERN, computer scientist Tim Berners-Lee circulated a proposal titled Information Management: A Proposal. His vision, a worldwide web of hyperlinked documents that would revolutionize information sharing. Most of his colleagues were underwhelmed. His supervisor called it vague but exciting. 3 years later, Berners-Lee had built the foundations of the World Wide Web. 3 decades later, as the web has become the primary interface for accessing human knowledge, his prediction has proven transformative beyond even his imagination. What's remarkable isn't just that Berners-Lee saw the technical possibility, but that he understood the social implications, how linking information would create entirely new ways of thinking and collaborating. His case demonstrates how sometimes the most valuable predictions come from those who combine technical expertise with deep insight into human needs, seeing not just what could be built, but why it matters. 79. In 1973, when computer networks were fragmented systems that couldn't talk to each other, Internet pioneer Vint Cerf co-developed TCP/IP with Bob Kahn. Their prediction: a standardized communication protocol would enable global computer networking despite hardware and software differences. Computer scientists, comfortable with specialized systems for specific purposes, questioned whether a universal protocol was necessary or even possible. 5 decades later, as TCP/IP has become the foundation for worldwide internet connectivity, linking billions of devices, their vision has been thoroughly vindicated. Their prediction wasn't just about a specific technical standard, but about the value of prioritizing interoperability over optimization. The case demonstrates how sometimes the most valuable technological predictions aren't about creating the most elegant solution for current needs, but designing flexible frameworks that can evolve with unforeseen future requirements, valuing adaptability over perfection. 80. In 1962, at a time when computers were primarily used for military calculations and business accounting, computer engineer Douglas Engelbart delivered a paper titled "Augmenting Human Intellect." His prediction: computers would become personal productivity tools that would enhance human cognitive capabilities. Computer scientists, focused on processing power and algorithmic efficiency, largely missed the significance of his human-centered vision. 2 decades later, as graphical user interfaces, mice, and collaborative software transformed computing, Engelbart's framework proved remarkably prescient. His prediction wasn't just about specific technologies, but about a fundamental shift in the relationship between humans and machines, from computers as replacements for human calculation to computers as amplifiers of human creativity. The case demonstrates how sometimes the most valuable technological predictions come not from extrapolating current technologies, but from reimagining the purpose of technology itself, seeing potential that others miss because they're asking different questions. 81. In 1945, as World War II was ending, MIT professor Vannevar Bush published an article in The Atlantic titled "As We May Think." His prediction: future machines would help people navigate vast amounts of information through associative linking, essentially describing hypertext decades before digital computers existed. Information scientists, still working with punch cards and paper files, couldn't envision the interfaces Bush described. 5 decades later, as the World Wide Web made his Memex concept a reality, Bush's vision proved remarkably prescient. His prediction wasn't just about specific technologies, but about how information overload would create the need for new tools that mimic how the human mind actually works, through association rather than hierarchical classification. The case demonstrates how sometimes the most valuable predictions emerge by deeply understanding human cognition and extrapolating how technology might evolve to better align with it, seeing needs that aren't yet articulated. 82. In 1950, when computers were still primarily used for numerical calculations, mathematician Alan Turing published a paper titled "Computing Machinery and Intelligence." His prediction: machines would eventually exhibit intelligent behavior indistinguishable from humans. Computer scientists, focused on specific applications like ballistics calculations, largely dismissed the philosophical implications of his vision. 7 decades later, as AI systems generate human-like text, recognize speech, and make complex decisions, Turing's framework has proven remarkably foresighted. His prediction wasn't just about specific capabilities, but about the fundamental nature of intelligence itself, that it could be understood as computation rather than something mystical or uniquely biological. The case demonstrates how sometimes the most valuable predictions come from reconceptualizing seemingly intractable problems, creating intellectual frameworks that transform how we think about profound questions like the nature of mind itself. 83. In 1945, while working on ENIAC, mathematician John von Neumann developed what would become known as the von Neumann architecture, a design where programs and data are stored in the same memory. His prediction: this approach would become the standard for all digital computers. Many engineers, accustomed to machines with fixed programs, were skeptical that storing instructions as modifiable data was practical or efficient. 8 decades later, as virtually every computer on the planet uses some version of von Neumann's architecture, his vision has been thoroughly vindicated. His prediction wasn't just about a specific engineering approach, but about a fundamental conceptual breakthrough: that a universal computing machine could be created by treating instructions the same as data. The case demonstrates how sometimes the most valuable technological predictions identify elegant principles that prove remarkably durable across generations of implementation details, ideas so fundamental they seem obvious only in retrospect. 84. In 1948, when information was still primarily a philosophical concept, Bell Labs mathematician Claude Shannon published A Mathematical Theory of Communication. His prediction: all information, text, audio, video, could be represented digitally and transmitted reliably despite noisy channels. Communication engineers trained in analog systems struggled to grasp the paradigm shift his work represented. 7 decades later, as Shannon's information theory underpins everything from error-correcting codes to data compression to machine learning, his framework has proven transformative. His prediction wasn't just about specific technologies, but about a fundamental reconceptualization of information itself, from something vague and qualitative to something precise and quantifiable. The case demonstrates how sometimes the most valuable predictions come from creating entirely new fields of study, intellectual foundations that enable generations of innovation that would be impossible without that conceptual groundwork. 85. In 1948, when most scientists studied either machines or biological systems, but rarely both, MIT mathematician Norbert Wiener published Cybernetics. His prediction: feedback loops and control systems would become central to understanding both technological and living systems. Scientists, trained in distinct disciplines with different vocabularies, were skeptical of this unified approach. 7 decades later, as cybernetic principles inform everything from robotics to systems biology to ecological management, Wiener's interdisciplinary vision has proven remarkably far-sighted. His prediction wasn't just about specific applications, but about a fundamental similarity in how complex systems of all kinds maintain stability and adapt to change. The case demonstrates how sometimes the most valuable predictions identify patterns that transcend traditional disciplinary boundaries, conceptual frameworks that reveal unexpected connections between seemingly unrelated phenomena and create entirely new ways of understanding complexity. 86. In 1942, as wartime production was revitalizing Depression-era economies, economist Joseph Schumpeter published Capitalism, Socialism, and Democracy. His prediction: capitalism would continuously destroy old industries while creating new ones, a process he called creative destruction. Traditional economists, focused on equilibrium models, were skeptical of this dynamic, disruptive vision. 8 decades later, as technological innovation has repeatedly transformed the economic landscape, from railroads to automobiles to computers to the internet, Schumpeter's framework has proven remarkably prescient. His prediction wasn't just about specific industries, but about the fundamental nature of capitalism itself, not as a stable system, but as an evolutionary process driven by innovation. The case demonstrates how sometimes the most valuable economic predictions come from understanding dynamic processes rather than static conditions, seeing the economic system not as a machine seeking equilibrium, but as an ecosystem constantly adapting and evolving. 87. In 1945, as centrally planned economies were gaining prestige for their wartime industrial achievements, economist Friedrich Hayek published The Use of Knowledge in Society. His counterintuitive prediction: decentralized price systems would always outperform central planning because they more efficiently process dispersed information. Mainstream economists, impressed by mathematical planning models, dismissed his argument as ideological rather than scientific. 8 decades later, as market economies have consistently outperformed command economies in innovation and living standards, Hayek's knowledge problem framework has proven remarkably insightful. His prediction wasn't just about specific economic systems, but about a fundamental limitation in human coordination: that certain kinds of knowledge cannot be effectively centralized. The case demonstrates how sometimes the most valuable predictions identify constraints rather than capabilities, understanding not just what's possible, but what's impossible given the nature of information and human cognition. 88. In 1963, when fiscal policy dominated economic management, economists Milton Friedman and Anna Schwartz published A Monetary History of the United States. Their prediction: monetary policy, control of the money supply, would prove more effective than fiscal policy for managing economic cycles. Keynesian economists, confident in government spending as the primary economic lever, dismissed their monetarist approach. 6 decades later, as central banks worldwide focus on inflation targeting through interest rate management, Friedman's monetary framework has become the dominant paradigm. His prediction wasn't just about specific policy tools, but about a fundamental shift in economic management, from direct government intervention to indirect influence through monetary channels. The case illustrates how sometimes the most valuable predictions reframe where power and leverage really exist in complex systems, identifying points of intervention that provide maximum impact with minimum disruption, insights that reshape institutional priorities and professional practice across generations. 89. In 1964, when most economists viewed education primarily as a consumption good, economist Gary Becker published Human Capital. His prediction: education and skills would become increasingly critical for economic growth as knowledge-intensive work expanded. Traditional economists, focused on physical capital and labor hours, were skeptical of this intangible asset framework. 6 decades later, as the knowledge economy dominates advanced nations and education premiums and wages have soared, Becker's human capital theory has proven remarkably prescient. His prediction wasn't just about specific job markets, but about a fundamental shift in how economic value is created, increasingly through ideas and expertise rather than physical production. The case demonstrates how sometimes the most valuable economic predictions identify not just cyclical changes, but secular transformations, shifts in the very foundation of wealth creation that gradually but inexorably reshape societies over generations. 90. In 1956, when most economists attributed economic growth primarily to capital accumulation and labor expansion, economist Robert Solow published a mathematical growth model with a revolutionary implication: technological progress, not factor accumulation, drives long-term economic growth. Traditional growth theorists, focused on quantifiable inputs, were skeptical of this emphasis on the unmeasurable residual factor. 7 decades later, as empirical studies consistently show that innovation accounts for most productivity improvements, Solow's technological progress framework has become foundational. His prediction wasn't just about specific technologies, but about the fundamental source of prosperity. That knowledge advancement, not just resource accumulation, determines living standards over time. The case demonstrates how sometimes the most valuable economic predictions come from identifying what matters most, not what's easiest to measure or manipulate, but what ultimately drives the system over the longest time frames. 91. In 1977, when climate change was barely on the political radar, economist William Nordhaus published the first economic model of global warming. His prediction: Climate change would create significant economic costs and require carbon pricing mechanisms to internalize these externalities. Environmental economists, still focused on local pollution problems, were skeptical of this global long-term approach. 5 decades later, as carbon markets operate worldwide and climate economic assessments inform international policy, Nordhaus's framework has proven remarkably prescient. His prediction wasn't just about specific environmental impacts, but about integrating climate science with economics to create practical policy tools. The case demonstrates how sometimes the most valuable predictions bridge traditionally separate disciplines, creating integrated frameworks that help society address complex challenges that can't be understood through any single perspective. When reflecting analytically, we see that Nordhaus recognized climate economics was not merely an environmental issue, but a fundamental economic transformation requiring new governance tools. 92. In 1974, when environmental regulation typically meant rigid command and control rules, economist Martin Weitzman published theoretical work comparing price and quantity instruments for pollution control. His prediction: different environmental problems would be better addressed by different regulatory approaches, with price mechanisms, taxes, sometimes outperforming quantity controls, caps. Environmental policymakers, comfortable with simple prohibitions and limits, were skeptical of this nuanced, context-dependent framework. 5 decades later, as cap-and-trade systems and pollution taxes have become standard policy tools worldwide, Weitzman's comparative analysis has proven remarkably influential. His prediction wasn't just about specific regulations, but about a fundamental shift in environmental governance, from treating all pollution problems alike to designing mechanisms tailored to specific contexts. The case demonstrates how sometimes the most valuable predictions introduce crucial distinctions that transform binary debates into more sophisticated policy frameworks, moving beyond ideological positions to pragmatic problem-solving based on the specific characteristics of each challenge. 93. In 1990, when resource management debates were deadlocked between government regulation and privatization advocates, political economist Elinor Ostrom published Governing the Commons. Her prediction: communities could successfully manage shared resources without either government control or private ownership through locally developed institutional arrangements. Mainstream economists, committed to the tragedy of the commons narrative, were skeptical of this community-based approach. 3 decades later, as thousands of successfully managed commons worldwide validate her framework, Ostrom's polycentric governance model has proven remarkably insightful. Her prediction wasn't just about specific resources, but about a fundamental third path in resource management, beyond the state-market dichotomy that had dominated policy discourse. The case demonstrates how sometimes the most valuable predictions emerge from careful empirical observation rather than abstract theory, seeing what actually works in the real world even when it contradicts dominant paradigms in both policy and academia. 94. In 1937, when most economists viewed firms as simple production functions, economist Ronald Coase published The Nature of the Firm. His prediction: transaction costs would determine the boundaries of companies and whether activities occurred within firms or markets. Traditional economists, focused on production efficiency rather than coordination costs, initially overlooked his framework. 8 decades later, as his theory explains, everything from vertical integration decisions to the gig economy, Coase's transaction cost analysis has proven remarkably prescient. His prediction wasn't just about specific business structures, but about a fundamental insight into organizational economics, that firms exist primarily to reduce the costs of using the market mechanism. The case demonstrates how sometimes the most valuable predictions answer questions others aren't even asking. In this case, not how firms maximize profit, but why they exist at all. This shift in perspective opened entirely new ways of understanding economic organization that continue to illuminate business evolution today. 95. In 1975, when corporate structure was primarily viewed through financial lenses, economist Oliver Williamson published Markets and Hierarchies. His prediction, economic institutions would evolve specifically to minimize transaction costs and resolve contractual problems, particularly those involving uncertainty and asset specificity. Business strategists focused on market position and competitive advantage were slow to appreciate this institutional perspective. 5 decades later, as his framework explains everything from corporate governance to strategic alliances to vertical integration decisions, Williamson's transaction cost economics has proven remarkably insightful. His prediction wasn't just about specific organizations, but about the fundamental logic behind institutional arrangements, why certain transactions occur in markets while others are brought inside firms. The case demonstrates how sometimes the most valuable predictions focus not on outcomes, but on processes, the evolutionary mechanisms that shape organizations in ways that might seem inefficient without understanding the underlying coordination problems they solve. 96. In 1990, when development economics focused primarily on resource endowments and policy choices, economic historian Douglas North published Institutions, Institutional Change and Economic Performance. His prediction, the quality of institutions, particularly property rights and rule of law, would prove crucial for economic development, explaining why some countries prosper while others remain poor despite similar resources or policies. Development economists, focused on visible factors like infrastructure and education, were skeptical of this emphasis on intangible institutional qualities. 3 decades later, as institutional quality consistently emerges as a primary determinant of economic success across countries, North's institutional framework has proven remarkably prescient. His prediction wasn't just about specific policies, but about the fundamental importance of the rules of the game that shape economic incentives. The case demonstrates how sometimes the most valuable predictions identify deeper causal factors beneath surface phenomena, moving beyond symptoms to structural conditions that enable or constrain prosperity. 97. In 2000, when development experts were debating aid effectiveness, Peruvian economist Hernando de Soto published The Mystery of Capital. His prediction, formalizing property rights for the poor, would unlock trillions in dead capital, enabling economic development from the bottom up through increased credit access and investment. Traditional development economists focused on top-down programs and macroeconomic policies were skeptical of this property-centered approach. 2 decades later, as property titling programs have shown significant impacts on investment and property values in multiple countries, De Soto's capital formation framework has proven remarkably influential. His prediction wasn't just about specific policies, but about a fundamental shift in development thinking, recognizing the entrepreneurial energy already present in poor communities that formal institutions often fail to acknowledge. The case demonstrates how sometimes the most valuable predictions reframe problems entirely, seeing not a lack of assets, but a lack of institutional mechanisms to leverage existing but informally held wealth. 98. In 1976, while working as an economics professor in Bangladesh, Muhammad Yunus made a small loan to a group of women bamboo furniture makers. This experience led to a revolutionary prediction. Small loans to poor entrepreneurs, particularly women, could reduce poverty more effectively than traditional aid or commercial banking. Development experts focused on large infrastructure projects and formal sector employment were skeptical of this microenterprise approach. 5 decades later, as microfinance serves over 140 million borrowers worldwide and has lifted millions from poverty, Yunus's banking for the poor model has proven remarkably effective. His prediction wasn't just about a specific financial product, but about a fundamental shift in poverty alleviation, treating the poor as potential entrepreneurs rather than passive aid recipients. The case demonstrates how sometimes the most valuable predictions come from direct engagement with problems rather than abstract theorizing, seeing opportunities that become visible only through proximity to the challenges they address. 99. In 2004, when most multinational corporations viewed poverty as a problem for governments and NGOs, business strategist C.K. Prahalad published The Fortune at the Bottom of the Pyramid. His prediction, serving the world's poorest consumers, the 4 billion people living on less than $2 per day, could create profitable business opportunities while alleviating poverty. Corporate strategists, focused on wealthy consumers in developed markets, were skeptical of this low-margin, high-volume approach. 2 decades later, as companies from mobile phone operators to consumer goods manufacturers have built successful business models serving low-income markets, Prahalad's inclusive capitalism framework has proven remarkably influential. His prediction wasn't just about specific products, but about a fundamental shift in how businesses view potential customers, seeing the poor not as charity cases, but as an underserved market segment representing enormous aggregate purchasing power. The case demonstrates how sometimes the most valuable predictions reframe apparent constraints as hidden opportunities, turning what looks like a social problem into a market solution. 100. In 1997, when most companies treated environmental compliance as a costly burden, business strategist Stuart Hart published Beyond Greening in the Harvard Business Review. His prediction, environmental sustainability would eventually become a source of competitive advantage, with the most proactive companies capturing significant value through eco-efficiency, product stewardship, and clean technology development. Corporate executives, focused on quarterly profits and regulatory compliance, were skeptical of this long-term, capital-intensive approach. 3 decades later, as ESG investing has grown to over $30 trillion and sustainable products command premium prices, Hart's sustainable value creation framework has proven remarkably prescient. His prediction wasn't just about specific practices, but about a fundamental shift in business strategy, from treating sustainability as a cost center to recognizing it as a driver of innovation and growth. The case demonstrates how sometimes the most valuable predictions identify emergent paradigm shifts while they're still barely visible, changes that ultimately transform what constitutes competitive advantage. And finally, our last prediction. In 1999, when industrial capitalism still dominated economic thinking, environmentalist Paul Hawken published Natural Capitalism with a revolutionary forecast. Businesses would eventually adopt models that preserve and restore natural capital rather than depleting it. Corporate leaders, trained in traditional profit maximization, dismissed this vision as impractical idealism. 2 decades later, as circular economy principles reshape industries and regenerative business models gain traction, Hawken's natural capitalism framework has proven increasingly influential. His prediction wasn't just about specific practices, but about a fundamental reimagining of capitalism itself, recognizing natural resources as capital to be maintained rather than commodities to be consumed. The case illuminates how our economic systems inevitably evolve to reflect our deepest values, eventually internalizing what was once external. As markets gradually price what was previously priceless, we're witnessing the slow but inexorable reconciliation of economic and ecological wisdom, perhaps the most important prediction of all. So that wraps up our journey through history's strangest financial prophecies. From George Soros's billion-dollar gamble against the British pound to Mark Twain's eerily accurate death prediction, these cases prove market irony is truly stranger than fiction. But now it's your turn. What do you think? Are these wild predictions proof of financial genius or just lucky guesses? Perhaps Edgar Cayce's Great Depression prophecy changed your perspective? Did we miss any mind-blowing financial predictions that deserve a spot on our list? Share your favorite in the comments. The best ones get pinned. If you loved this dive into market madness, prove it. Hit like, subscribe, and ring the bell so you don't miss our upcoming exploration of billionaire blunders.